Having institutional investors for a retail investor is the single most important thing if I'm sitting in their shoes. And I've been both sides. I've been a rich man, I've been a poor man. As you know, I delivered pizzas and flipped burgers before any of this. And I started my first investment company with a $3,500 loan. So I've been on both sides of this discussion. The reason the world of investors, of managers, is divided amongst the ones that have institutional investors and the ones that don't. Period. There's a line of demarcation between them that is made in stone. And the reason why is if you have a institutional investor, that means you have passed a gauntlet of diligence by their financial advisors, their board of directors, their auditors, their accountants. That means your reporting has to be of some means that they've done background checks. They mean they've looked at your track. I mean, they have looked under the hood at a level that a retail investor doesn't even know how to do. They don't even know what they don't know. And so and by the way, I was a manager that didn't have institutional capital. We brought in people, great. The deals were good. They made money. So it doesn't mean something is wrong with someone that doesn't. They can still be good managers, but it means they haven't stress tested that manager enough to where it's not just about how good their deals are, it's how good your risk controls are. How good is your reporting? Are all of those things up to snub? So the vast majority of our money is institutional money. The vast majority. High net worth capital, don't hold me to it, but I want to say is like 15% of the money that we have, which is a great advantage to a retail investor putting in 50 grand, 100 grand, whatever the number is, because if I let them invest in a deal that 3 institutions have already done diligence on, does it mean for sure it's going to make money? No, but their degree of certainty, their level of comfort they can have in the deal that they're doing of knowing that it's top, A++ quality stuff is much higher. It depends on person by person, right? So if it's a financial advisor, they want to know, can you be approved with what's called a CUSIP number? Can your fund or product be with TD Ameritrade or Fidelity? And we've been approved with TD Ameritrade and Fidelity both, in different capacities. So then they're able to invest with you, but there are different due diligence qualifications for each pension. And I think that's the real advantage for a retail investor is if you go talk to XYZ firefighter fund, they'll have a list of questions that they want to know. They'll call references, they'll look at deals, they'll background checks, you name it. And each one of them has a slightly different way of looking about it. Some are more intrusive, some are more data oriented, some involve more meetings in person with the board. And so the cool part is once you've done that so many times, it helps you refine your process. So when you go to the next institution, you've already created a repository of all the questions, all the files, all the things that they need, which creates the momentum to grow it. Because once you have one, you're going to have 10 or 20, as long as you don't, start losing people money and doing boneheaded stuff. And people do it. Markets go up, markets go down. We've been very resilient in our approach. During COVID, we actually closed on 16 major deals. So we're very much contrarians at how we look at the world. When people are asleep, we're wide awake. When people are exuberant doing a bunch of stuff, I'm sitting on the couch. And so there's a way of right now, as an example, where you start reading the headlines of the office market is down, interest rates are high. I've never seen better deals in my life. So it's a way that you actually see the world and the way that you can convey that vision. But most importantly, how do you back it up and what are the documentations and what is the track record to show it? And a lot of people don't have audited track records. And the difference between an audited track record and a track record is very simple. A third-party accountant firm has checked the numbers that you're out telling people to make sure you're not what's called cherry picking, which means you just show all the good ones and you don't show the bad ones. Audited track record means there's all of them. And whatever that percent return is, XYZ, it's shown, it is what it is, and it's verified by an independent third party. And what we purport to show people is only our audited track record.